In this example, we have a company, and the company has a depreciation report to 30 June 2020, whereby what we want to do now is we want to create a depreciation report to 30 June 2021. So let's go ahead and add in the opening balances here. Obviously, we'll need the historical depreciation report for that purpose, and we must set our opening date, which will be 1 July 2020, which is the first day after the last day of this depreciation report. So save off on that, head over to Tools, and let's add in the group. So it's for a business, non-primary production, related business, and that's the type. Let's add in that asset. So we simply pick up the asset from here. So noting that we've picked up the cost, we'll continue with 100% taxable use percentage. The date. Now notice the accumulated depreciation. You can use Logit to do the calculation for you, but you might find that it's not exactly the same as what you have from your brought forward depreciation report. So simply use that instead, so you get that exact same written down value. So that's 7,600. And now if we have a look at our depreciation report, what do we see? We see that we've got our 30,000 and we've got our opening written down value 22,400, which is the closing written down value from the previous depreciation report. And of course this will then tie up with your accounts and you'll be able to roll forward as you'd expect. And here we have our balance sheet, profit and loss reports. You'll notice here that we've got the depreciation and the accumulated depreciation on the motor vehicles at cost. So let's import that depreciation, balance sheet and profit and loss report, and see how this all works in the tax return with the 2021 and 2020 comparative years. Our balance sheet at cost and the accumulated, and the profit and loss, the depreciation. Don't forget, of course, you've got to make sure your classifications are correct for this to work well. And that seems to have worked. So we're going to link those accounts. Let's have a look down here in depreciation section. Okay, so that needs to be motor depreciation, and now we'll be able to link the cost, and we can now see how this will work if we open up the tax form. So it is 2021, right? Inside the profit and loss, we should see the depreciation for the motor vehicle. Bear in mind that we're not using the small business entity depreciation rules here. And on the reconciliation, we have our non-deductible motor vehicle depreciation. This is the accounting value coming in from Excel. So that is essentially treated as non-deductible, but then we take out the same value, which is then the tax depreciation value, which is coming off the depreciation report. So the motor vehicle depreciation value coming off of the depreciation reports. Right? And if we have a look now, let's just take a snip of this so I can show you what we see when we look at so we'll build out a set of special purpose reports for this entity. Sorry, that's where I made a mistake. 2021. If we have a look in here, we will see motor vehicle depreciation, tying up with what we'd expect here, right? So there's our 5,600 worth of depreciation, and there that is there. And if we have a look at our financial position, again, that lines up nicely. So we've got our cost, we've got our accumulated, and of course at the end of this given year, which is the 30 June 2021 year, we've got our accumulated matching nicely with that, and we've got our written down value or closing assessable value matching nicely. And of course we've only got one asset, so it's pretty easy to see how that works. Now let's assume that this was sold just before the end of the financial year for 18,000, which I believe will give us a small profit here. Let's have a look. So we've made a profit of $540. With the changes that we've made, so the asset is gone, and in the profit and loss report we've now got a profit on disposal, and the depreciation value has changed. So let's make sure that these are all mapped correctly, or the revenue might need to be adjusted. But here you can see how we use the increasing balancing adjustment, and we need to align that with increasing balancing adjustment on motor vehicles, and then we'll be able to link it. We've got our expense mapped correctly. How does that then reflect? Well, let's, before we go any further, make sure that we've got a sort of an image that we can compare, make sure that we're doing this correctly. So first things first, let's look in the tax return. And inside the tax return, we see the disposal of the vehicle. So this is the profit on the disposal, showing as other sale of goods and services. But what we essentially do is that gets stripped out in here. So we should strip it out down there. And the way to strip that out, which I haven't showed you, is to get the mapping right and treat that as non-assessable. So, I've reflected it correctly there. But anyway, this is what you would do. Just treat that as non-assessable, because the tax calculations from the depreciation report will reflect the correct gain as other income, and you'll see what I mean here. So just jump back in here quickly. Obviously, this is coming through the revenue section. It's mapped through the revenue, but it's not really revenue. It's just some kind of other assessable income, right? So this other assessable income is coming in from here. So this is the other assessable income. Taxable gain, it's essentially a taxable recoupment of the depreciation, given that the asset was sold for more than what it had been depreciated down to. So that's our recoupment. And if we have a look at other income not included in assessable income, it's coming out down here, which is essentially that accounting value. So the accounting value coming out and the tax gain going in. Hopefully that makes sense. And then if we jump over to our custom reports, and have a look and see how it's reflected in here. We've got our increasing balancing adjustment reflected there, which you saw obviously getting mapped. So that is essentially how the accounting value will be reflected, the accounting gain on disposal. And of course on the financial position side, the asset is gone, so disposed of. Now let's sell this for 16,000 so that we generate a loss. Let's see how this looks from a depreciation report perspective. Remembering this is a tax depreciation calculation. So we've got a $1,460 loss there and $4,950 in the way of depreciation now. So we've updated our inputs to match. Right. Let's see this here. You can see 4950, 1460, 4950 now in the expenses section. 1460 the loss in there. And let's see how that imports. Sorry, wrong place. Over to financials. We want to import this again now that we made the change to incorporate a loss on disposal. So all I'm doing is importing that file that I've updated. Let's see how this changes our inputs. And don't forget to fix the mapping. So now what have we got? We've still got our depreciation, which has changed, and now we've got a loss on disposal, which we're treating through the through the expenses section. So classification, anything that's really changed will be in here. Let's have a look. Now I'll come down and show you here, depreciation mapped in, and then this is loss. So loss or decreasing balancing adjustment, and decreasing balancing adjustment on motor vehicles, which we'll treat as, which we'll tag as, so we're going to link it with motor vehicles and we're going to tag it as non-deductible. And you'll see why I'm doing this in a second. If we head over to the tax form, see how that change has updated in the tax form. So in the profit and loss section, we've still got it. So we've got our updated depreciation, 4950. We've got a loss, 1460. Our loss being an accounting. So this is an accounting loss, right? But if we go back into the reconciliation section, we've got non-deductible expenses, including, so the depreciation is treated as non-deductible and the loss is treated as non-deductible. But through here, we have the decline in value for the depreciation, which, because we're using a tax depreciation on our accounts, it's one and the same value. And then also in other deductible expenses, we've got that loss on disposal, which is the tax value, obviously coming through from the tax depreciation calculators. And if we had a look in here, we'd see how it flows through there, right? And there's the depreciation. So that's the loss on the disposal of the depreciable asset, which is the motor vehicle, and so that's the tax value, and the decline in value, which is the tax value for the depreciation. Hopefully that makes sense. If we head over to the custom reports and we have a look in here, so we've got now a decreasing balancing adjustment, because in this case the asset was sold for a value that meant that the written down value at the point of disposal was still greater than what it was disposed of for, so therefore there's an increasing or a decreasing balancing adjustment. And there's the motor vehicle depreciation, and if we have a look at on the balance sheet or statement of financial position, our assets have obviously been disposed of there.